in this topsy-turvy market, what are the sectors you should be focusing on to maximise your potential return? David Sokulsky is from UBS Wealth Management, and he's going to give us the inside running on which stocks sectors we should enjoy a stellar second half of 2014. David, I hope that's not too much pressure on you, is it?
We'll see how we go.
Well, ultimately, that's what the name of the game is, to know where the money should be going.
Yeah.
Okay. So what are you seeing in the market right now?
I think when you look at the Australian equity market, we've obviously had a great run. It's been, a situation where the economy's been strong for a number of years, and when you look at it relative to other economies around the world, we sit in a very good situation. I think the equity market reflects that. So. Yep. If you look at overall valuations, we're at about 14.3 PE valuation. That's around the long-term average.
Yep.
So if you look at where can the market go from here, you're probably not going to get a whole lot of PE expansion. You're really going to rely on earnings growth.
Yeah.
So the question is, can the economy grow? Can companies grow earnings to actually drive some of that growth?
So did you look with interest at Treasury's forecast last week, which to me look as though they went pretty conservative on the growth number?
I think they've been very conservative, and I think they're trying to paint a pitch that they can give some upside down the track.
Yeah.
We're certainly a lot more positive on the Australian economy, and I think growth can easily outperform.
I noticed the Reserve Bank even put a 4.25% number on 2015-16, which might be at the high end, but that is still. If a number, even with a high 3 in it, came along, that'd be pretty good for earnings as well, wouldn't it?
Yeah, I think we're at about 3.4%. So we're certainly, probably higher than consensus. And as I said, we're very positive on the economy. I think earnings growth next, financial year 14, we've got earnings growth about 14%. So
that's nice.
Again, that's very positive.
Yeah.
Most of that's been driven by the resource sector.
Yeah.
We see some expansion out of the financials, but it's really the resource sector which.
Okay, well, I'm sure a lot of my viewers hear you talking resource sector now. They've copped a bit of pressure over the last few days. The iron ore price is coming down. What's the thinking behind resource sector being a big deliverer on earnings?
Sure. If you look at what the companies have done, particularly the larger companies like BHP and Rio, they've certainly worked on their cost base, and they look like a pretty efficient sort of machine at the moment.
Yep.
If you look at their current valuations, they've been hit fairly hard, and I think a lot of the pessimism, particularly about the iron ore price, about the strength of the Australian dollar, about potential fallout from China and a property crash, a lot of that looks like it's been priced in. So for us, it seems like there's a lot of upside if any of that doesn't turn out as planned. So if we get a bit of weakness in the dollar, if the iron ore price stabilises or even rebounds, and if China isn't as bad and we've sort of overreacted a little bit, there's a lot of upside for those commodity companies.
But also, David, how important in your story is the US recovery ends up being as strong as some of the optimistic economists, and there are economists out there who are putting 4s and even 5% numbers on growth in the US, which seems really high, but some of them are quite credible economists. I think Chang from what's that? I've lost what company. One was Fargo. Anyway, a well-known US economist this morning, I heard him speaking, he's got a really big number on growth. Now, given that, I got greenback going up, Aus dollar coming down, and that's going to help your story as well, isn't it?
Yeah, we would agree with that. If you look at the US economy, obviously we had a pretty bad winter.
Yeah.
And I can tell you firsthand, given that I just came from the US and was iced into my house for a number of days.
Okay.
It obviously weighed on the economy.
Yeah.
There's no doubt about that. And if you have a look at first quarter GDP, it came out at 0.1%, which was way below expectations. I think a lot of people have reacted to that in a variety of ways. If you look below that headline number, it actually wasn't that bad. Sales to domestic recipients was actually about 1.5%, so much better than expected. If you look,
the number was about 0.2, wasn't it?
Yeah, 0.1, I think. Yeah.
Yeah.
When you look at where the economy can go from here, we think it can easily grow at around the 3% mark. The housing recovery is still intact. If you look at the low interest rate environment, that looks like being there for some time. If you look at employment numbers, unemployment claims were very strong last week.
Yeah.
Housing
and jobless claims are a really important indicator for the S&P 500.
They're crucial.
You put them together, they nearly just mirror each other.
They are. The official employment numbers are a little bit backward-looking. The employment claims are more real-time, so they're very valuable.
Okay, so that's good news. What about the actual companies we're talking about, BHP, Rio? Are they going to benefit from a global economy that gets better? Like we know, I would have liked to thought Europe was growing a little bit stronger than it currently is, but I suspect Draghi's going to do something in June, bring out the bazooka, and this time he might actually pull the trigger. If he does, would you put that together and say, US looking good, Europe's bound to improve, China's may well have been a too negative assessment on China. By end of this year, we can have a pretty strong global economy for 2015.
Yeah, look, I think you've painted the exact picture there.
Yep.
The US looks strong, it's recovered, the banking sector is restructured. It certainly looks like it's going forward from here. Europe, is growing. It's certainly a better situation than it was a year ago.
Germany, 0.8% growth, wasn't it?
Germany looks good.
Yeah.
Some of the countries that we're really worried about, like Spain, is looking much better.
Yeah. Ireland's doing better.
Ireland's better.
Yeah.
And, when you look at what Draghi can potentially do, we're probably looking at a 15 basis point cut in June. That's probably getting to the end of the rate cycle, so then you've got to do quantitative easing. And we've seen how that's helped Japanese equities and US equities. Probably expect the same for Europe. So, in terms of some of those resource companies, that's obviously going to help.
Yeah.
Any kind of strengthening economy is going to help demand for their products. With China, it's obviously a risk. The property market there is not, the best. There's a lot of data that's come out which suggests that, it's turning down. But in saying that, the government there has a lot of options that it can take to steady that downward movement and to also redirect some flow. So by that, a lot of the iron ore, say, output and things that the resource companies put out here go into housing construction there.
Yeah.
Now, if the government decides to replace some of that housing construction with infrastructure spending, then a lot of that still just goes to infrastructure spending.
Yeah.
And the rail networks that they're planning to build in China are quite enormous. So the impact on those resource companies here, can get overplayed a little bit, when people talk about the negative impact. And that's why I say a lot of that has been priced in, and perhaps it's been priced in too much.
And also, David, we can't get used to big numbers for Chinese growth, but the bigger their economy gets, the smaller the growth number can be, and they still can produce pretty good demand for resources, can't they?
That's an excellent point, and a lot of people forget that. That a 6% growth, on a bigger number is much more sort of volume. And you've seen that with the iron ore imports in China. The volume is actually still at record levels.
Yeah.
The price has fallen, but volumes remain very strong, and that really should continue.
Okay, let's talk asset allocation. A show like mine, I'm having difficult words tonight. A show like mine often focuses too much on stocks. Asset allocation. Where do you reckon a lot of us get it wrong?
I can talk about, say, a general investor in Australia.
Yeah.
And if you look at a general investor in Australia, they've probably got a very high allocation to Australian equities.
Yeah.
Now, in every country, there's a hometown bias. And we have the extra benefit of franking credits here. And a few other tax benefits such as superannuation, which probably give us a little bit of a higher allocation than what other countries
The
should
franking
have.
credits can be nice, particularly if you're retired.
It's very nice. But when you look at that, we probably have too high of an allocation. We can allocate overseas, especially when you consider that Europe has turned a corner.
Yeah.
A lot of the companies there have restructured, and there's a lot of, if we do see any kind of impact from quantitative easing and rate cuts on the euro, a lot of the European exporters should also have a little FX kicker there as well.
Yeah.
So, we see a great opportunity to allocate more offshore, particularly in Europe. As you mentioned earlier, US growth is certainly strong. There's a lot of opportunities in the US where we think Australian investors can take advantage.
Yeah.
One of those is, US technology. The US is really at the cutting edge of technology, and there's some wonderful companies there that are doing some great stuff that you can't access just with domestic equities.
Would you play Europe with a fund or with an ETF? Because you guys do both. So
We do.
Yeah. So, but which one? Like, if you're a person who's not really a stock picker, but it's still a bit of a stock picker's market, is it picking the right companies? But is it ETF or is it a smart fund manager?
What I would say is, for somebody just stepping into that realm, I would start with an ETF. Once you become comfortable with the markets in Europe, then I would start to look at my other options. Maybe supplement that with a fund manager, supplement that perhaps with some direct equities.
Yeah.
But the key for any investor is really to feel comfortable with where they're investing. And for a first-time sort of entrant, probably the ETF's the best way to go.
Okay, bonds. A lot of us don't buy bonds, but the professionals do play bonds. What's the advice you would give people around bonds?
You know, I mean, the bond market in Australia is an interesting one. I mean, there's a high premium here. When you look at US 10-year yields,
less than 3.
Way less than 3.
Yeah.
When you look at Australian 10-year yields,
2.5, wasn't it?
Yeah, about 3.7 in Australia.
Yeah.
So there's a real benefit for allocating to Australian bonds as opposed to foreign bonds, and that's one of the key reasons why we've seen the Australian dollar rally and been strong for the last couple of years. Now, it's a good option if you're looking at pure bonds, but then you would ask, why would you allocate to why would you over-allocate to bonds when you've got a lot of yields elsewhere?
Yeah.
You know, when you can look at equities offshore, when you can look at some of the banking stocks here, when you can look at the resource stocks, which can appreciate a lot more. So government bonds is probably not one of our preferred sectors, but if you're looking at bonds only, the Australian bonds are very attractive. Yields have been held down low globally for some time, and I think it's been frustrating for a lot of investors because a lot of people have expected yields to rise, and a lot of that comes into their equity valuations and some of their themes, and it's really thrown out a lot of people because excuse me, they don't really understand what's going on there. And there's probably been a couple of drivers. Everyone talks about the demand for bonds and quantitative easing sort of getting tapered, reducing the demand, and then we expect rates to normalise. That's definitely the case, but they forget about the supply side of bonds as well. And when you've got the deficit in the US shrinking, you know, first 4 months of last year we had $195 billion in Treasury issuance because of the deficit. This year we only had 133. So you've got a much lower supply of bonds, which obviously drives up the price, drives yields down. You've had a lot of flows from pension funds which have their allocations now in equities. They've done excellent. They've got their sort of long-term targets met.
So they're rolling into bonds.
So they're rolling into bonds.
Yeah. So it's not a rejection of stocks, is that they've got their allocation.
Yeah, they're happy with what they've got.
Yeah.
So there's a few factors there which, you know, are working at the same time as quantitative easing tapering, and it's offsetting it.
Yeah. One last thing, a quick one.
Sure.
Where do you think the ASX 200 will finish this year?
You know, UBS has a target of about 5,700.
Yeah.
And just looking at some of the earnings growth we're seeing and some of the economic growth, I think that's a pretty fair target.
Yeah.
You know, that gives a little bit of upside from here. So it's quite a positive
I'm
story.
calling it conservative, but still it's heading in the right direction.
Let's
David,
hope it
thanks for
outperforms.
joining us, mate.
Thank you very much.
Cheers.